was some 22 measures apparently. I'm not going to go into 22, but let me just highlight 10, which I think are important. And we'll sort of put some of these questions and ask Anish to put on his financials analyst hat and tell us which of these measures gives the maximum bang for the buck, right? So shift to EC, expected credit loss provisioning. There's a 4-year glide path to this now to smoothen the one-time impact of additional provisioning. Remember, basically they're moving away from incurred loss model to a projected or expected credit loss model. But the news is the 4-year glide path to do this. Removal of proposed restriction on overlapping businesses. Basically, banks doing what they could not do on the bank side, in subsidiaries, NBFCs, etc. There was always this overhang that because the rules don't allow for it, they'll have to do. Some of these companies will have to sell these subsidiaries, but so that overhang kind of goes away. Introduction of risk-based premium for deposit insurance. It's basically 12 paisa per 100 rupees. Now it is. It's a flat rate, but now it's moving away from a flat rate. So it doesn't look like much, but it is expected to give a bump to underlying profitability for banks. Banks can finance M&A. So far, banks could essentially fund acquisition of underlying assets, but not equity shares. Now they're allowed to do it. So we'll see how much of this. Does the capability exist for banks internally in terms of people and systems, etc., to be able to price some of this? And will we see a big wave of M&A because of this? We'll see. But in any case, it's good because companies were going for private credit, dollar-denominated debt, higher cost. So all of that is easier now. NBFC risk weights lowered for infrastructure, so PFC, REC. So basically for operational projects, lower risk weights. Withdrawal of the 2016 large borrower guideline. So basically there was a 2016 circular which discouraged lending to borrower entities having aggregate sanction limit of over 10,000 crores. This basically has been repealed. There is also loan against shares, which has been for banks, which has been enhanced to 1 crore. So it's a 5x jump. For NBFCs, it is still larger. This is for banks. Now, easing restrictions on transaction accounts, so current account, OD, etc. So this again is important because most of the current account is with banks like HDFC Bank and private players who are good in transaction banking. And the rules said that if you have less than 10%, to be able to have the current account with you, you've got to have more than 10% exposure to a given entity, borrower entity. So this was creating some amount of anxiety that's been now eased. Discussion paper for granting new urban cooperative bank licenses. And of course, just simplification, 250 master directions to replace lots of scattered circulars. So it was a monetary policy, but not very much in terms of monetary policy itself. A lot of easing essentially aimed at unshackling banks, if I can put it that way.